present written and verbal advice on the law, legal procedures, and a wide range of business-related issues, especially in the decentralized sector. And Nathan is now part of the Web3 paradigm shift. He's building successful decentralized applications with compliant decentralized governance. May I request all of you to please put your hands together to invite back on stage Nathan. Nathan Vandy, the CEO of Bond.credit, and he's also a big supporter of this event. So thank you, Nathan, and over to you.
Thank you so much. One question. Is there a way for us to do like a 20-minute? Hello, everyone. Glad to see you all today. Got a nice crowd, nice turnout. Today we're going to be talking about the rise of agentic finance and the transition that we're going to go through from mainly yield agents that are the predominant agents that we see on the market today, and how we're going to mature that market into agentic capital markets. A little background on myself. I'm a legal professional, still doing my part-time doctorate in blockchain law and governance, but I'm currently the CEO of Bond.credit, where we are underwriting and providing credit to AI agents. So let's start with a little bit of a history lesson on how the internet has developed. And the reason why I wanted to start here is because the agentic economy builds up on some fundamental blocks that are necessary for us to understand where we're going. And the internet was one of the most important, where it allowed us to both read and write information. And crypto was that next evolution, which allowed us to own information, because at the end of the day, a crypto asset is data, right? The next development that we've seen recently is AI, which allows AI to then have its own sovereignty as well. So it's an entity that has its own sovereignty through LLMs. And agents are this new way for this new digital entity to read, write, own, and manage assets, whether that is assets on the financial side or also human capital as well. And so the reason why this is really exciting is because of the composition of agents. I'm sure you guys will hear a lot about what an agent actually is, but we've had the pleasure to actually speak to countless of teams actually developing agents in the space. And this is how we would break it down. The agents, they have a combination of an AI model. Some of them use ML as well, in order to do the reasoning, the strategy, and this allows them to move rather than human speed at machine speed. They have a wallet, and this is super exciting as well. This is one of the most important shifts from what was known as bots before to agents, because this allows the bots to own actual digital assets. And beforehand, they had to be in the custody of the owners. The next one is identity as well. And the reason why this is so important is because the fact that the agents are on the blockchain, they're able to build up their identity, they're able to build up their credibility persistently across protocols over a period of time. And they all manage capital. This is one of the most important parts, because it's not just data. Like, some agents are actually managing humans as well. They're managing stable coins. And this is something that we're going to get into a little bit later when we're talking about agentic capital markets. And last but not least, these agents have objectives. So similar to how the difference between an assistant and an agent, these agents have like one objective that they're meant to do, and then they use a combination of LLMs or ML or a combination of both in order to achieve that. And so, yeah, as mentioned, this is that transition from bots to semi-autonomous agents to autonomous economic actors. it's getting quite exciting now, actually. I'm not too sure if you guys have been aware, but in Argentina, they're now talking about a new legislation where instead of you having human-managed entities, you're going to have AI-managed entities. This is something that Malay is pushing, and it's something that we've already seen. I don't know if you guys were here earlier. We've already seen DAO-managed entities, and with DAO-managed entities, there's a threshold of 20%. So as long as the human is doing less than 20% of the work, then it can be considered a DAO-managed company. And this is likely going to be the same that we'll see with these AI-managed companies, where as long as humans are doing less than 20% of the work, it's going to be considered a AI-managed company. And that really brings in some interesting questions around identity, autonomy, and also accountability. So I'm sure you guys have heard a lot about agentic commerce today, so I won't get too deep into that. But when people are talking about agentic economy, there's two main paradigms that we're looking at. We are looking at agentic commerce, which is mainly looking at the management of goods and services, the selling and buying of goods and services. And we can go deeply into that and see how it crosses over into agentic finance. But the main focus today is going to be agentic finance, which is looking at the management of capital on chain, looking at how they optimize yield, how they mitigate risk, and how they construct portfolios and rebalance. And so this is where trust underwriting and infrastructure matters the most. And the agentic economy is emerging. We looked at a few of the statistics that A16Z shared around how big the agentic economy can get, and they project that it can rise to 17 trillion. And I think a lot of this people underestimate will also come from stablecoin adoption, because agents are going to be managing stablecoins rather than humans are. Right now, the stablecoin size is 146 billion. It was bigger before 1010, but we are currently in a contraction of DeFi, and I believe that's going to grow once we go through this trough. And then 51 billion is the depth of the lending markets. And interestingly, this number is very important because right now, majority of the money in the DeFi lending market is in static vaults. And I'm not too sure if you guys are very deep into crypto and have been following, but for the past 9 months, we've had the worst hacks in the industry with billions of dollars lost in a combination of smart contract risk, but most of it was actually governance risks. And by including agents, you're able to remove a lot of that human risk that you have when it comes to managing capital. And so that's what we're going to start seeing. We're going to start seeing this shift from static vaults to agentically managed vaults. But to get there, we do need trust because most people don't actually trust agents yet. And so this is something that we've been looking at quite deeply. The thesis is pretty simple. There's already capital on chain for these agents to manage, and they're already managing this capital. And so with more trust, we're going to be able to start optimizing both yield and risk. This is pretty interesting. Agents were managing nearly $250 million before 1010, which is no small amount of money. And then we saw how the lack of trust in first DeFi and then agents made that go from around 225 million to roughly now where it's around 40 million. And so a big goal of what we're looking to do is get an understanding of how we can concentrate trust around this capital, because trust is the moat. And so the question has developed from do agents exist to how can we trust them with capital. And for the next session, we're going to be inviting CEO of Zi-Fi, Gautier, to the stage. Please give him a round of applause. So Gautier is one of our partners, Zi-Fi. They are one of the biggest agentic finance agents in the space. Yeah, get yourself comfortable.
Yeah, thanks. There you go.
They're one of the biggest agentic finance agents in the space. They've been building for the past 2 years now, and they have managed to amass around, is it like 12 million now under management?
No, we're more at 6 right now. Yeah.
Okay.
But we reached 13 million assets under management. That's at peak, yeah.
At peak. Yeah. And so we're going to ask a few questions around what your vision is for agentic finance. We're going to ask questions around what agentic finance is not, so definition by omission. And then we'll look into how you're preparing for the future of the capital markets as well. So
sounds good.
Brief introduction on yourself, and then we can get going.
Yeah, for sure. Hey, everybody. Pleasure to be here. I'm the founder at Sci-Fi. We basically are building a yield agent embedded into users' wallets, which allocates capital across different lending markets. So I've been building in this space since around 4 years, around DeFi and account abstraction. And yeah, that's about it.
Cool. So from your perspective, what is not agentic finance?
What is not agentic finance? Yeah, that's a tough question. I would say like most of DeFi today is just manual intervention and you know, people interacting with wallets and different applications, different front ends. So it's it's still like you need a human in the loop, and that's mostly how DeFi is built out today. So that would be my answer.
So basically static vaults.
Yeah, static vaults and manual interventions and manual monitoring. Yeah, just having a human in the loop mainly.
Amazing, amazing. And so what is the main transition that you see in the market happening right now when you're talking to people about transitioning from static vaults to agentic finance?
Yeah, I mean, like, in order for people to access DeFi, you need to make it accessible. And today you cannot ask like a user to, like, I think some of you guys are already using DeFi on your own and you know how to interact with the apps, to understand what is gas and understand how like a vault works and like the collaterals inside of the vault, like where the yield is coming from. But most users, they don't need to understand all this. They just want the final product, which is potentially yield or any other type of financial product. So in order to simplify that and to make it accessible, you need some sort of automation, some sort of agent that can act on behalf of the user and abstract all that complexity.
Yeah, could we have a show of hands? Is there any people using DeFi in the building today? All right. And those who are not, have you used crypto wallets in general before? But you haven't used DeFi before. Okay, interesting. And so from your perspective, what is one of the reasons why you haven't used DeFi? Interesting. So if, for example, you realize that you could get more yield APR from DeFi than your traditional bank, would you be interested in? Yeah.
That's a good question, yeah, for sure. I mean, yeah, that's true. A lot of people are still scared and they don't know how to use it. So, I mean, that's the biggest bottlenecks right now. And agents solve exactly this. Like, they improve risk monitoring. They improve the fact of, like, for example, we've integrated over like 60 pools around 10 protocols, like biggest DeFi blue chips. So as the agents interact with these protocols, they abstract all that complexity. Like, user does not have to go into these different front ends and do all these complex operations and monitor the risk and rebalance the funds to improve the yield, or like a vault has, you know, liquidities coming out, you need to basically get out, and you can't have humans, you can't ask a human, at least most humans, to do these type of things.
Amazing. I guess the next question is, we saw a couple of hands for people that have used DeFi. How many people that have used DeFi have also used DeFi agents? Wow. Okay, like a whole zero. So that shows you how early we are, right? We're at an AI agent summit, and there was no one that raised their hands on using an AI agent for DeFi.
Yeah, I mean, try Zi-Fi. You can also try. There's a bunch of agentic wallets out there. Coinbase has one. MetaMask just released one. So yeah, there's a lot to play around. Right now, people are just trying them, speculating around different projects that are building around agents through agentic wallets. And so yeah, give it a try and see how it works. And yeah, for example, on our side, we basically provide an agent that handles and provides yield for you. So you can just connect your wallet, deposit funds like 10 USDC and just give it a try, and you will see it does everything for you. It finds the protocol, finds the best yield, and monitors the risk on your behalf. So
yeah, so when I first started using agents, it was early 2025. So Bitcoin was like going towards 100,000, and I wanted to take some money out of the market, but I wanted to deposit it in a place where they had optimized yield, right? And so that was the first reason why I started using agents, because I saw that manually having to move my assets from Morpho to Aave to Fluid to Euler, it was quite time intensive whilst I was running a company. And so having the agent optimize it for me was one of the main reasons why I did it, to outperform the market in a safe way. I'm not gonna lie, I didn't put a lot at the beginning. I put $100 just to see how it worked, and then I started to put more. What are the main reasons from your customers do you see them utilizing your agents?
I think the main reason, and we're still trying, like, it was funny because we're doing interviews, we're trying to understand really why they're using the product, and it's a last user I asked was like a diversification. So users have like funds in different DeFi protocols, and they just starting like trying something that works on their behalf, that can rebalance, monitor the markets, and yeah, just do things for them. So that's what we've seen, and we've seen like a lot of people with a lot of funds that just deploy a small amount. So people are really testing, seeing how it works, and then I mean, need to build that trust to see that automation can work. If you have specific guardrails, if you have audits and a track record of just funds being rebalanced correctly, and after you bring all these things together, then you're able to start bringing trust, and people can start using automation and have something that can work for them, basically.
Amazing. So earlier on, when I was explaining how the TVL went up to 225 million, and then it went all the way down to 40 million, we were interviewing a lot of these big LPs who had put 5 million plus into these agents. And we were asking them why they removed their capital after first 1010 happened, and then after Resolve happened as well. Like, a few of these shocks caused them to remove capital from agents. From your opinion, do you think that it's them removing capital from agents because they're scared of agents managing their capital, or do you think it's because of fears around DeFi risk?
Yeah, I mean, overall, the TVL went down, so eventually smaller protocols, people probably see them as something which is more riskier, and I think anything that is related to agents and automation maybe could scare people off more. But at the end of the day, like, what we've been able to do on our side is, for example, there was like the USR DPEG. So our agent monitors like specific DPEGs inside of a specific vault. As soon as the asset DPEGs over 2%, it starts withdrawing the user's funds. So it also in some way improves the security, and I think people are still they don't see that exactly. And I think a lot of people, so when people withdraw, we ask them, there's a small feedback box, say, hey, why did you withdraw? And some it's stupid, but some say, hey, there's this, it was, I think, Fable from Anthropic, and like people say, hey, I'm scared of AI. Like a lot of people like withdraw these days, like, and they say like, it's AI, I'm scared of AI. So I think like there's this moment in the market where like all these hacks happen and just people are afraid of what AI can do to the market. So I think that's one of them, but yeah.
So you think people are in like capital preservation mode, and anything that they don't understand, they would prefer to not allocate to?
Yeah, I mean, it's just a moment of the market where, like, you know, hacks are happening, and as they will slow down, and we improve the security, we improve risk monitoring, we do more audits, we just improve the way we do things, provide privacy, and all these things put together. And at some point, we'll also have, like, you know, agents that continuously audits the protocols, and basically, like, all these things put together, I think will just bring more trust as there will be less hacks. So that's my thesis, and we just need to be patient and wait till the market recovers a bit more.
So what you're saying is we need good AI agents to fight the bad AI agents.
Yeah, in some way, I would say that. Yeah, for sure.
Yeah, because I was at a conference in SF earlier this year, and the banks were talking about how they also have this cat and mouse game when it comes to security, right? Where there's always going to be adversaries that are getting a better understanding about how to breach security, and they have to always be pen testing and hardening. And how has that process been for you over the past 9 months with these recent hacks?
Yeah, I mean, we've been audited 3 times. So, and then we've been actually hands down focused on, like, basically when you come to Sci-Fi, you create a safe wallet, and then you sign what we call session keys, which basically gives specific constraints of what the agent is allowed to do. So basically you're approving different contracts, and so we built something very solid which enables this very constrained rules for the agents while keeping flexibility, meaning that we have a multisig which can edit the destination contracts of the agents, and this enables us to keep those constraints for the agents, but also add new opportunities, because there's a bunch of new vaults, new yields, and you don't want the user to come back and sign again those session keys that gives these constraints to the agent. So we've been really focused on that, auditing that, making sure that there's no way that if the agent is compromised, he cannot send funds to another wallet or do any type of malicious transaction. So it has specific guardrails that it can act upon, and that was our heavy focus. It's just providing this good infrastructure, secure infrastructure, to then provide different type of strategies. So because right now the agent is just allocating into different lending markets, but you could see it do way more things. You could have a borrowing agent. You could have an agent that does looping, and also something we're thinking about is having an agent that can find the best borrowing rates against a stock, and then lend out at the best rate. So you can do way more automation off chain, but if you have the right infrastructure and the secure guardrails for in order to do so.
Nice. So one of the things that we mentioned in the previous conversation as well, that we had in the morning is this distinction between agents managing capital for you or agents managing capital with you. And so agents managing capital with you is almost like the agent being your wealth manager, where you give the agent your money and you say, hey, go make me more. And then agents managing with you is like having a co-pilot that you're able to bounce ideas off, create a strategy with, and then run with that strategy. Which bucket would you say that Sci-Fi falls under?
I mean, it's I would say in the middle, because the user, when the user comes, he can choose the specific, for those who don't want to, waste time, making their own strategy and really choosing the vaults, they can just choose a risk profile. So they can choose conservative, aggressive, or we have a yield maxing strategy. So for degens, who people want to take more risk. And inside those strategies, the user can pick a specific protocol and even pick a specific vault inside that protocol. So he can make his own selection. And then the agents can rebalance, put the user's funds at the best place, split the funds if it improves the yield. So it's a mixture of both. Like user makes a selection, but then like there's automation happening and execution on that user's behalf.
Amazing. I guess like we've got two more questions. One of the main questions is about communication, right? Because in crypto we've always had this like PR issue where it feels like we're speaking a different language to other people outside of our bubble, in a sense. So when it comes to explaining what DeFi is, a lot of people in traditional finance, they're like, what is DeFi? And you have to explain what it is. They don't see themselves as TradFi, they just see themselves as normal finance. And so do you think like that we're going through something similar with agentic finance as well, where there's almost like this translation issue where even though there is empirical evidence that the agents are outperforming on both yield and risk, there's almost a block in actually being able to communicate that without losing the user in jargon that they don't understand.
Yeah. So for us, when users set up an agent with us, they connect their Telegram. So then they receive notifications every time there's an action. Every time the agent is doing something, it explains. It says, hey, we've moved your funds from this vault to this vault because it provides a better yield. We moved your funds from this vault because there was a DPEG. So we have a little chatbot that people can interact with. They can ask questions. So that's our way of providing this sort of education. But at the end of the day, like, I think users just want like yield, and they just want something secure, and they just want something which is accessible. And you need to provide them that. And you need to provide also customization. So, and the problem today we have with DeFi is that everybody has like these vaults, funds are like put everywhere in the same place or commingled, and user doesn't have any like any say, any customization of what he can do. So agents connected to smart wallets enables way more for the end user. And my thesis is that we're going to see an increase of that across DeFi. Vaults will still be there, but you could see a future where people will have wallets with an agent, and then they can have intents, and they could actually interact directly with each other. But we need way more like scaling and way more things to come to that. But I believe one day we will be there.
And you said one day. Can I tempt and ask you for time horizon on that? And what are the things that need to be done to unlock the users and the capital to then move towards agents managing capital?
I mean, yeah, you need just better guardrails, better policies, better monitoring systems, simple ways for people to come on chain, scalability, and just start building the blocks to like also like as we grow the TVL and we grow the size of users we have and make sure they're satisfied and all these things. I think we'll be one of the players, but I think it's also like how we can improve as an industry, like how agents operate, how they're able to do real things and provide real value for users, and as also blockchains can scale and improve overall.
You missed one question about the time horizon.
Oof. Yeah, I'd say maybe like in 2 to 3 years.
2 to 3 years.
Yeah, I think we'll have way more people interacting with the on-chain world through an agent and a wallet, basically.
So that's when the flipping in happens.
Yeah, I think it's coming slowly but surely. Too slow for me, yeah, for sure.
Slowly but surely, I like that. Thank you so much, Gauthier.
Yeah, thank you for having me.
Well, thank you so much, Nathan. And Nathan will be staying on the stage because he's part of the next panel discussion as well. And we are continuing with the theme of trust, risk, and accountability. And to take the discussion forward, I would like to introduce to you and invite on stage the moderator. He likes to introduce himself as a father, husband, and a crypto veteran. Actually, husband, father, and a crypto veteran in that order. And he helps passionate early stage Web3 founders access trusted security expertise, one-to-one consulting, workshops, discounted audits, and partner deals through partnerships with venture firms, hackathons, accelerators, incubators, and ecosystems. Please join me in welcoming on stage Michael Van Baelen with a nice big round of applause. And Michael, if you would be kind enough to introduce the rest of the panelists and take it from here, over to you.
All right. Thank you. Can you hear me? First of all, the title. Can we have the title of the panel? Autonomy on Guardrails. It's a bit of a complex title, but it's actually a very simple question. How much power do we want to give to agents or machines without human approval? And we have 4 experts here that will help me answer a couple of questions. Nathan, he's already here on stage. Phil, please, Phil. William and Julian. We will all give them a mic so they can also introduce themselves. So AI is not really anymore about summarizing texts or writing weird posts on LinkedIn. It's a bit more complex right now. People ship code with agents, they access APIs, they move money around, and we will kind of discuss how we can do this in a way where it's secure and we can actually trust these agents to touch money, infrastructure, and etc., etc. Nathan, we can do it in the right order, or yeah. Nathan, please have a seat here. Okay. You can introduce yourself.
So I'm sure you guys have seen my face once or twice. The name is Nathan Vandy, once again CEO of Bond.credit, and we are underwriting and providing credit to AI agents. We're very, very bullish on agents helping humans to optimize yield, but most importantly, preserve capital through risk mitigation. And so we create a benchmark of the best agents in the space and then help them to get capital.
Hi, I'm Phil. I'm the co-founder of Cork Protocol. We're building the rails for risk. So we're building the infrastructure that allows you to take any risk trade and tokenize it. And then ultimately that allows agents to operate on both sides of those trades and come and create custom risk products, whether those be hedges, liquidity products, downside protection, traditional insurance contracts, all done on-chain, represented as tokens with smart contract logic, actually settling those transactions.
All right. Hi, I'm Julian. I'm a verification engineer at Runtime Verification. That means a software engineer and security researcher. We build developer tooling, first and foremost, formal verification tools, but also, among others, debuggers, fuzzing tools, and more to improve security in the software space. For example, for smart contracts, but also other software stacks and solutions.
My name is William. I'm the founder of RNSID, which is the technology provider behind the Palau residency program. So the Palau e-residency is the second program after Estonia e-residency. The difference is we're on-chain. And we have been doing this for 4 years. One of the key issues that we try to resolve is to avoid profiling of people. Right? That's why we created LDID, Legal Decentralized Identity, where you generalize a claim. So instead of, say, I'm born in 1994, over 21, true, right? And Yeah, and then we're also exploring on like agent identity to see like what innovation can happen from that perspective.
All right, thank you, gentlemen, for the introduction. I have a quick question for the audience. Who is using cursor here in the audience? And how many of you just auto-approve everything it does? Okay, that's less than I expected. So yeah, that's also what we're going to discuss today. We see a lot more code that is obviously AI generated, and security is getting more and more important. So let's start with the first word of the panel. So I'm kind of going to dissect the panel word by word, and the first one is autonomy. Gentlemen, how many or how much autonomy are you these days giving to AI agents? Are you going all the way, or where do you draw the line right now?
So autonomy's always been an interesting word because it's got dual definitions. So you can look at autonomy from a technical perspective, like automation, which is something that happens automatically through mechanics or software. But then you can also look at autonomy through like a political lens, when you have an autonomous country that has its own sovereignty, it's independent, and I think it applies to agents quite nicely on both sides. But when it comes to allowing autonomy, it's also a spectrum too. And one of the nice frameworks that I was looking at was when the human individual team behind the agent transitions from being an operator of the agent to an observer of the agent. So the agent is managing most of the actions, and the human is just watching and intervening when things don't go well. And right now, predominantly, I'm more on the operator side rather than the observer side when it comes to both coding and on finance as well. With majority of the work that I do, but when I do use agents like Zi-Fi, I'm more on the observer side, where the agent runs 24/7 without me intervening.
I think it comes down to, for me at least, is it reversible? And so when I'm coding or vibe coding, and I'm doing it inside of a clean machine where the blast radius is actually very small as to what the agent can actually do in terms of damage, go to town. Go do whatever you want. There's nothing. When you start introducing money into it in an irreversible way, like sending stablecoins on a blockchain, all of a sudden the mentality changes. And so you start to think about, okay, is there a minimum that's okay? Like if it only has $10, can I give it autonomy? And most people would say, sure, like whatever you do with my $10 is fine. But what can you actually do with that $10, right? You actually need to start thinking about what happens when you actually want to say, I want to give you a bigger budget, but I only want you to spend $10 at a time. Can I trust that you're not just going to do 1,000 $10 transactions really fast, and that's that you're going to be able to get around the guardrails that I put up? And so as long as anything is reversible and inside of an environment that you feel is safe, I think you should allow your agents to have full autonomy. It's the only way that we're going to learn what that autonomy actually means, right? I think of it very similar to raising a child, where you give them autonomy until you're like, sure, you can go play in the street. You can't run into the street. But the minute you run into the street, it's like, well, your autonomy now needs to be scaled back because you're not following the rules. And if you don't follow the rules, I can't let you have autonomy. So it becomes sort of the same thing. And over time, we hope that these systems learn and scale in a way where we can give them more autonomy.
Yeah, for me, it's both the worst case scenario. So when you have autonomous agents or semi-autonomous agents, they typically do more things than just read available data on the internet, like with a deep research query in a web browser. Typically, you employ agents that handle information, that handle funds, and other things we possibly cannot imagine agents can do. And with data, for example, they can publish data, they can destroy data and information. With funds, they can move funds, destroy funds, they can generate funds. And all these things have upside, especially when you let them run autonomously, but they can also have considerably downside. And so for me, the first and foremost thing is for agents to not create too much downside risk. And even if it does destroy data, of which I have backups, if it costs me time, then the agent has just cost me time, maybe even at a point in time where I cannot afford to lose time. So I want to employ and deploy agents that have lots of upside and no downside.
Human can make mistakes. So what I'm trying to say here is that for like our panelists here, because we're all human, right? So in a sense, we're also profiling on the because it's an agent, but like from what we did for LDID, right? For legal DID, is there was an example I always give, right? So when I apply for a job, like they will see my resume, right? On there, William Wang. So they know immediately I'm Asian, Wang, and I'm a male. My race and my gender has nothing to do with my merit. But if I'm applying for accounting or HR, they may prefer a female, right? So in a sense, we're profiling on people already based on other aspects, right? So they should like actually judge me on my merit, like what did I study, my working experience, but the first thing they see is my race and my gender. Same as AI agent, right? Are we going to trust an AI agent doctor better than a human doctor? I think we should judge them based on the merit, right? A human doctor can also make mistakes. They can cut your, kidney, or like even a dentist, they can make also a mistake. So I think when we try to judge on the AI agent, we don't profile them, right? We should, based on merit and what they can do, and if they have proven they can do it, right? Then I think we can trust them better than human. So how much autonomy can you give them when they have a better ability? I think it's just based on how much and how credible they are doing their work.
Phil, I really liked your comparison with the child, giving it autonomy slowly. Nathan, this is kind of what you're working on, right? Can you elaborate a little bit more about the kind of a trust of a AI agent, a credit score of an AI agent? How does it develop? And how does your platform work, actually?
Yeah, definitely so. I really liked what Mr. Wang said on the end, where autonomy has like different design philosophies, as my two friends said here, but also it's based on reputation, and reputation is very contextual. So for example, the credit reputation that you give to a student when it gets a student loan is very different from the credit reputation that you give someone who wants to take out a mortgage. So you need to focus on one specific area to provide a credit score. You need to find like a vertical. And so the vertical that we focused on was financial AI agents that are managing stablecoin yield. And we found all of these agents in the industry because, one, we don't have to worry about downside as much compared to trading agents. Stablecoin yield agents should actually maintain their principal at all times, as long as they don't depeg. And based on that, we started to look at 5 different subcategories of these agents. We looked at their performance, we looked at their risk, their provenance, sentiment, and then based on these subcategories, we combined them into one score. And if they reached a certain level, then they were allowed to get capital from us. And So over the past 9 months, we've given these agents such as Zi-Fi 10,000 of our own internal money. And because the agents didn't lose any money during the worst DeFi period, we've now given these agents 100,000 of our own money to manage. They were able to outperform the market both on yield and risk. And so we're now able to fine-tune this credit engine that we have for these agents. And we were recently awarded by Robinhood an innovation award for this credit engine that we've produced for agents. And the goal is that as these agents continue to perform, we'll be able to increase the amount of money that we give them, because capital only moves as fast as trust does.
So you have given... So you have given an AI agent 100K and you still sleep well?
Yes. That was a bit of a pause, right? No, like, as I said, we gave them 10,000 first as a small amount, just to see how well they were able to manage that. And our team reviewed the audits on the agents. We reviewed the technical side as well. We also monitor the assets that the agents manage it too. So there's 2 levels of monitoring. The agents are monitoring it, and then we're monitoring the agents and the assets as well. And so by doing that, that gives us a lot more certainty over this process, because in the early 2000s, big billion-dollar hedge funds started using algorithms, high-frequency trading algorithms, to manage their capital. And a lot of them initially had this fear of giving their assets to these algorithms. But if you fast forward 20 years later, over 50% of the capital market is managed by high-frequency trading algorithms. And so we see this same trajectory happening as well. As Gautier said, hopefully it won't take 20 years for it to happen, and happen in less, and we might see that hockey stick happen. But this is, they built up trust over time, and that's why we feel more confident deploying more capital.
So a few points on that. One, we've had high-frequency cause flash crashes in the market. They're not perfect. Even though they now manage billions, if not trillions of dollars, they can cause real systemic damage to the market. And that's essentially what you have with these systems over time, is they do earn some level of trust, like a credit score, right? And you should earn it, like you said, Will. Like, that should happen over time as these things get better and get tested in the market. But when you think about what a credit score actually does, it doesn't actually give you more autonomy or open up the ability for you to do things that you couldn't do with a low credit score. What it does is it changes your cost of capital, right? You can get a loan at a cheaper rate. You can get a bigger loan, right? And that's what it enables you to do. And it's also one input into a much larger system of making decisions and doing underwriting on risk. And what we need to start thinking about as agents gain more autonomy and agents start being more widespread and potentially having levels of systemic risk in the ecosystem, is how do you insure it? How do you actually put a price on the risk that is being created? And so what you actually want to see happen is these scores that get created for these agents should lead to cheaper insurance costs. And ultimately, right now, it sort of seems totally inconceivable that you would be able to insure an agent, right? Right now, like, no one knows how to underwrite that. No one knows how to price that. And if you think back, I don't know how many people here were in the crypto space in the 2014, 15, 16 timeframe. You couldn't get insurance on cold custody at the time. Lloyd's of London, when they wrote the first policy for Coinbase on their cold storage infrastructure, it was capped at a ridiculously small, I forget the number, but it was a ridiculously small, in like the tens of millions of dollars, and cost in excess of 5%, right, of the amount of assets that were being custodied. Now you can get cold storage custody on true cold storage on pretty much unlimited volume and at incredibly low cost. Over time, the insurance industry figured out how to measure that risk. And if you compare that to, what happens to yourself when you get insurance, right? Like, if you get insurance on your house, the insurance company might say to you, well, you don't have a lock on your door, so there's no way I'm giving you insurance, right? Now you've installed the lock, I'm going to charge you $1,000 a month. But if you get an alarm system, I'll charge you $700 a month. And in fact, if you upgrade your lock, I'll charge you $600 a month. You get a guard dog, I'll charge you $500 a month, whatever it is. Over time, those same standards will emerge in the insurance space for this, and you'll be able to actually price the risk that these agents have. And you'll also hopefully be able to buy blast radius insurance, so that if something happens because an agent goes rogue that wasn't your agent, it now can actually come back. And I think the real conversation to have about this is actually about accountability. And that, I think, is going to come back to an identity conversation as well, as how do you identify who's accountable?
Yeah, very interesting. So we will actually have insurance for our agents.
Hopefully.
Very cool. Very cool. Next one is identity. William, what should we have to prove from a trust perspective, and what does it? What does identity mean when the actor is actually not a person or a company, it's an agent? That's more your expertise.
Yeah, I think that depends on how we classify the AI agent, right? And if that has already have a legal separation with the person who create the AI agent. For example, you can create an AI agent which is completely separate from yourself, right? Could be a trust, right? Like people, making trust to like completely separate from their own asset, right? And you can make the AI agent to do trading by itself, and if gains, if it lost, it's just by itself. It has nothing to do with your own tax filing, right? Or the AI agent can be owned by you. But if it's owned by you, is it an employee? Because that can be taxed differently, right? Are you paying for, the employee tax? Or is it a contractor, right? And if it is a contractor, is it, like an LLC? Or like what legal, and like this is what I'm talking to the Palau president, right? I say you should allow people to, register AI agents, right? As a company or like, a nonprofit, for example. If it makes, profit, then like how is that profit going to be spent, right? Is that going back to the society, or is it like, you can use that profit to hire more people? And yeah, so again, the AI agent, like, if you don't have a clear definition, I think it's probably back to your personal thing, right? So if it makes, makes money or something, then it's, is on yourself. Tax filing, it could also be owned by a company, right? So instead of like under your own tax filing, it could be under that company, right? If it is a BVI or or Palau, then you can save some, you can do some tax optimization, right? This is like, I mean, like most people use the e-residency for. Yeah, so I think, first of all, we need to understand how is this AI agent being classified. Yeah.
So with autonomous agents, we will also have different scales of agents, I'm sure. So with a timeline of possibly now ANI, later AGI, and then in the possibly in the future ASI, that means artificial general intelligence and artificial superintelligence, we will have to have the question of identity more often, and the perspective of what it means will also possibly change. So we can have humans deploy agents, we can have agents deploy agents, we can have agents possibly deploy humans. We don't know what's possible and what will happen. And so in that sense, I find it really exciting to think about this, but also we have to be really careful with the systems we set up, because we do not know what the possible extent is and of both future systems and possibly even current systems. But I think, in my opinion, we can certainly tie the identity of agents to the identity of the persons and also companies that deploy them, and having that as a starting point is a really good starting point for both accountability and also for possibilities and capability of agents.
I think the legal structure around this is actually going to start to come into focus a lot sooner than we think as this space proliferates very quickly. And you're going to have some definition of what, both from a tax standpoint and also from just a general legal and accountability standpoint, because I think at the end of the day, the fundamental principle is that identity can be delegated, but responsibility and accountability cannot be delegated. So ultimately, it's going to have to trace back to, did you tell something that led to something else, that led to something else, that led to something else, and across an entire chain, as a society, we're gonna need to know the identity of how that happened in order to hold people accountable to what their actions do, even if they didn't conceive of them themselves, which is gonna be a whole new area of case law that's gonna be fascinating. My intent was not to, take an extreme example, my intent was not to kill somebody, but my agent spun up another agent that went out and hired a hitman, because it solved my goal of, winning the lottery or whatever it is that, you actually set the goal out to be.
Yeah, I love that last point about the legal principle and difference between mens rea and actus reus. It's like mens rea is like what is your intention, your mental intention, and actus reus is like what actually happened. And we're going to start seeing how that works out, especially when agents start hallucinating, even if you tell them to do something, and whether or not that hallucination that they did came from maybe your bad prompting or bad LLM integration as well, and so that starts to create a new level of also counterparty risk as well, because maybe the LLM was depending on a bad data source, and maybe it was the bad data source that caused the LLM to hallucinate rather than your bad prompting. And how do we align those questions? Recently, there was case law that's starting to be developed around LLMs that allow people to have hallucinations in themselves. And there was someone who used an LLM to decide to kill his own mother, rest in peace. And so some of this case law will start coming out to identify where the accountability lies. Is it the LLM company? Is it the individual himself? Or can one day the agent itself, tied to its lifeblood of compute and its own economic resources, be shut down because it was the one that actually pushed?
Yeah, I think that's really the interesting point is there's things that you as an individual who spawned an agent can be held responsible for, but then can the LLM or the company who developed the LLM, can the company who's running the server, right, can any of them be held responsible as well for certain things? And it's going to be really fascinating to see how that plays out. We've already started to see with what happened with Fable last week, where the government already has said, oh, there's going to be export controls on this because what this is capable of is too scary for us to allow into certain hands, right? And they're already saying that at the LLM level, that they're trying to regulate what the LLM is capable of doing, right? And so if it goes beyond, and I think that's where the first legs of regulation are going to be, is that there are going to be laws that are passed that says, if the LLM can do this, you are responsible, right? Because that's the only way that you can easily hold people responsible. Holding the individual responsible for going and, cracking code and stealing money, sure, you are responsible for that, and that's, current law solves for that, right? You stole the money, we can see who stole the money, but the enabling of it is also illegal.
Yeah.
That's always the thing with innovation. There's always a couple of years of gray zone where we don't really know what we're doing, and especially on the legal side of things. Beside the legality, the identity, and insurance as well. Let's talk about security, like pure security. This is more Julian's expertise. Obviously, you all know what you're talking about, but Julian, what would you like to see on the security side of things if you, like Nathan here, want to put 100K and you don't want to lose any sleep over it?
Well, first of all, I have respect for you to put 100K into an agent and let it run and sleep comfortably. I wish I could have that high quality of sleep. So what I would love to see is, of course, more importance of security. So if we take a look at the landscape of AI agents and technology, we can see amazing LLMs that are incredibly intelligent. We can see open source agent frameworks like OpenClaw and Forks and other similar tools that allow you to build agents of all kinds. You can use tools of all kinds and handle assets of all kinds. So we're seeing advancement in both intelligence, reasoning, and agency, but less so in terms of security. So it is incredibly easy to set up an OpenClaw agent and let it handle your entire life, but it is incredibly hard to let it do so in a safe manner with guardrails that you can set up that go further than just writing down in a markdown file what the agent is allowed to do and what not, because the agent can and will eventually not follow the rules written down in a markdown file. So we need proper workflows and pipelines in place to do so. And even if we set up many sandboxes, workflows, pipelines, and guard-rated tools, when given untrusted user input, an LLM can always try or behave in the worst possible way imaginable, since LLMs still to this day are prompt injectable, which is the rumored reason why Fable was cut off and export controlled in the first place, because the security guidelines on Fable can be circumvented, according to rumors. So in that sense, we need more development on multiple fronts. We need security layers, multiple of those, that can consist of encapsulated tooling, more advanced sandboxing, and also more lessons learned. For example, in smart contract security, over time, we've learned how smart contracts can be hacked in a multitude of ways, and then later on we learn from those lessons and make smart contracts more secure. That is just one of many examples in the security landscape, but this is an example of we try something, we see it fail, we observe how it failed, and we think about how we can stop this from happening. And with LLMs, we should try to think a bit ahead of time and try to stop the worst case from happening before it actually happens, especially when handling assets that are important to us. It can be millions of dollars for a company, or it could be the pension funds of an individual person that is invested in assets. Both are important to the respective group on people and companies and so like. So we need more technology, we need more research in that area, and also we need to make sure that the worst possible thing that can happen is bounded downwards and cannot possibly happen, because with prompt injection, which to this day is unsolved, the worst possible case can happen, either by a malicious attacker that profits from it, or even by a malicious attacker that does not even profit from it, but still makes the user, the agent, deployer, lose their assets, their funds, or cause damage, and so on, and many more things.
Yeah, I think one of the really important areas to understand when it comes to security is, anyway, in finance anyway, is the difference between decision making and execution, because AI can be used in both areas. And you mentioned the ability to bound an agent, so like limit some of its activities, and you can do that through whitelisting or blacklisting guardrails, and that allows you to have a level of determinism to the entire stack of the agent, which could compose on the decision-making level or the risk analysis level of LLMs, but then also on the execution level that can still be deterministic as well. And so that allows the agent to have like a wide range of activities that it can do, but the activities is still dependent on its own intuitions through the LLM. And I think we're going to start seeing some combinations and variations of agents that have this balance of non-deterministic decision making and then deterministic execution to ensure that prompt injections become a non-issue.
I think one of the scariest things right now about agents is that they don't follow the rules, right? You can say, do not do this, and somehow they can still do that, right? And you can do it at a very high level. And so the beauty of pairing agents with smart contracts is that at the smart contract level, you can enforce a rule of what the agent is actually capable of doing in a transaction. And so you can actually build out a set of smart contracts that say the maximum the agent can spend at any one time is $10, and in any 1 hour they can only spend $50, and in any given time period, and then you can build something else on top of it that actually is alerting you to that in real time, so you can see if your agent has gone rogue, right, or is even trying to spend more than it's allowed to do and trying to break the rules. And that gives a little bit of financial comfort. It doesn't solve everything, but it does give a great deal of, when you're dealing with on the transaction side, some comfort around security.
If a person is able to make some drugs, you cannot blame his chemistry teacher, right? If you teach them how to build, they know how to destroy. So sometimes it's just inevitable for LLMs. You know, there's like 1,000 ways for them to, to circle and do what they want. So I think the ultimate way to guarantee security is still by rule of law. You have to have a law, to punish them, right, if they do bad things. So yeah, that's my perspective.
All right, thanks, guys. We often see in security that many of the hacks actually are because the scope was not wide enough from the security, or protocols just see it as a checklist rather than something that's actually the most important. Julian, where do you right now see like the biggest gaps, especially with AI coming in the picture?
So the biggest gaps are that we have lots of upside for agents. Agents can be used in a way that provide value. So we do this already, and we want to let them do even more. But that is being done before we know how we can deploy them safely and what attacks are possible, and then these attacks will happen. You guys mentioned how agents can be already bounded, how tool use can be whitelisted and blacklisted, how smart contract usage can be limited by means of limits, for example, on a weekly manner, on a per transaction manner. And those are tools that we figured out we can use to deploy agents more safely so that these bad things don't happen in the first place. And so doing that is very effective, and definitely think that should happen. But it also is not rigorous, and that's also what we've seen in the smart contract space, that smart contracts have been engineered in a safe way, or so we thought, and then somebody comes up with a really interesting hack or way to evade security guardrails, a hack, and steal user funds or similar. And so the same thing happens with AI agents, just blacklisting or whitelisting tool use, just limiting the funds that can be moved on a weekly manner, on a monthly manner or more, might just not be enough. And what we need is just rigorous analysis and modeling. That means we need to define what is an agent's purpose, what does the agent need to do that, what are the goals in a quantitative and qualitative way, and how do we set up a sandbox where the agent can achieve its purpose while not following the orders it was given. We can let other agents, of course, try to ensure that and have workflows that increase the probability, but we can also have software code in place that enforces this. We can have proper requirements documents and specifications for what a model is supposed to do, and we can transform this into code and formal logic and constraints that have to be followed, and we can even simulate the effects of actions that an agent does. We can, for example, simulate what a plan of or a list of actions an agent does will have as an effect on a blockchain, on a file system, or on a database, or in an email list, and then at the end, check whether the collective effects on the assets, on the data, and more are what we want and fulfill the constraints. It could be that the individual tool use is not okay, but the collective tool use of multiple actions might be okay. We might, for example, create a backup of the file, copy the file to some other place, delete the file, and then copy back the file, and in the end, the data is still available. But only the collective set of actions fulfills the constraints. So we need these tools to secure and guardrail ever more complex agents before we actively deploy them. And we need to set up these guardrails and these tools, and there will be a lot of different ways to do that. And I'm sure even today we can set up very, very specialized agents if they do provide upside, and that's exactly what we should do with rigorous analysis and deployment.
All right, final question for everyone. Do you think that at some point, as Nathan said, we will only be the observer and there will be AI agents, acting autonomously within those guardrails we discussed, handling billions of dollars?
Yeah, I'm betting on it for sure.
If you say yes, timeline?
Timeline, well, my good friend Gautier said 2 years. For billions, I do think it's gonna be 2 to 3 years that we can start to see that happening. I think we're already on our way to get into millions, hundreds of millions by next year. You've got players like Robinhood, Coinbase, MetaMask that have created agentic wallets now and are pushing their users towards that. Then, so you've got agents trading with you there, and then you've got players like Zi-Fi, Giza, Surf Liquid that are creating agentic fund managers as well. And as the trust starts to cement in the industry, as we start getting the right security and underwriting and insurance there too, maybe sort out the legal identity side as well, that will create the trust and coordination for the capital to move. Because as we like to say, capital only moves as fast as trust does.
I think the line right now between algorithmic trading and agentic trading is pretty fine, and you can definitely try and put a very fine definition on which is which and say, is algorithmic trading is truly deterministic, and you actually have autonomy in agentic trading where you don't actually know what's going to happen. But a lot of what we're seeing right now that we're calling agentic trading, it looks a lot more like algorithmic trading, right? In a lot of cases, someone is sitting there creating a skill, right, and being like, okay, this is what I want you to do. I want you to follow this pattern and do this, this, and this. And the actual autonomy in what your intention is actually not that high. There may be some autonomy in its execution, but the autonomy and the intention isn't there. And so, if you think about, there was at one point, I think you said almost $250 million that agents were trading on chain. Were they really agents trading that, or were they algorithms that were just being deployed by agents, right, to actually do the trading? I forget the exact number off the top of my head, but it's a very high proportion right now of capital out in the universe. It's actually being run by machines. It's actually significantly higher than you would even think in terms of the total global scale of capital. But it's not agentic, it's not truly autonomous, but it is machine-based. And if the machine had, the difference between an agent making a mistake because it hallucinated and there being a bug in the code, well, what's the difference in reality? And so, ultimately, where my mindset around risk comes from is that you have to be able to price all of this. You have to have backstops. In order for these things to get to billion-dollar and eventually trillion-dollar scale, which will certainly happen, unless we somehow outlaw, AI and agents altogether, which is not a zero probability event, you will have this money being managed because that's the direction of travel. But in order to do that effectively, you have to start being able to price the risk associated with it. You have to have collateralization and backstopping against that, because in the traditional financial system, you have that. You have and some of the reasons why we think that blockchains are so much better for finance in general is because it removes a lot of these intermediaries, right? But what do the intermediaries in finance do today? They allow you to unwind trades, and they provide capital backstops, right? And sometimes unwinding these trades seems totally unfair and just like a crazy thing to do, but sometimes they're done because it makes the system work, right? And so sometimes you have something crazy go on a Friday afternoon in a commodities market, and over the weekend they unwind all the trades that took place so that they can open at normalized levels again the next day and have efficient working markets, right? That's a necessity that exists right now. We hope that we've gotten to a point and learned enough that we can start to replace all of that with code. But that's really why you need to have risk systems in place and risk capital and risk backstops.
I really like to comment about the lines being blurry between algorithmic trading and autonomous agent trading and more, Phil. With that thought, I think it will be fairly quick until we get autonomous trading of billions in the way that Phil outlined. But I also hope that we will get more autonomous handling of funds in the future that will be less algorithmic and more depending on actual security guidelines in place that work. But I think with all the difficulties and challenges we'll have to solve, it will actually take a lot of time until we get to this point, because once billions are at stake, that will not just happen because somebody simply tries it out and see whether something will go wrong or not. That will be done in a rigorous manner by default. And that makes me hopeful for the future that we will have proper development and research in this space, in the tech, and also on the economic side. And I'm really excited to see how that will unfold and when it will happen.
I don't have more to add.
Thank you, guys. Any questions from the audience for these experts?
It's in the US, it's legally undefined right now. And one of the reasons why you have to have full supervision of self-driving cars is because the driver of the car is responsible. When you're looking at things like Waymos, right, which don't have a human driver, Waymo is responsible. And so if something happens, it's not like there's a person who's going to go to jail for manslaughter because they ran someone over, but financial liability is held by, and so the criminal liability stuff is actually where a lot of this hasn't been written yet, and there is no answer to the question. Financial liability is almost always answered for these things before any of these things touch the streets. And one of the things that's a little crazy about the LLM advancements is it's happening so fast that and without any regulation whatsoever, that none of this is being defined. And there's very likely going to be a real pushback and pullback at some point, because some event will happen, and I don't know if it's going to be all of a sudden we have to unplug the machines, right, to solve for something, but something is going to happen where this is going to force to be answered, and thus that's when you're going to get real, answers to these questions on the LLM side.
There was another question, I think.
Yeah, it's connected to the previous one.
like we can definitely see it. Yeah, thank you. If it's like come to something physical, I don't know. Like, okay, automotive, it's more or less we understand who is the operator here, but when it's come to the weapon, how it can be traceable? What do you think?
I think it goes back to counterparty risks, right? So even when you're looking at something simple or seemingly simple like the GDPR, the General Data Protection Regulation, you have to create this lineage of who is the data controller, who's the data processor, who's the data sub-processor. And so you start to see this linkage of who's managing the data, who's transforming the data, who's loading the data. And through this, you'll be able to understand where some of the accountability starts to lie, but it will be very contextual. That traceability, I think, we'll be able to find through that data mapping, but the individual cases will be context relevant.
Thank you.
Any other questions? No? Thank you, guys. I would be able to talk AI with you all night, but I think we are far past our time already. Thank you to the audience, and see you next time.
Thank you, Michael, and all the panelists on stage to really give us that in-depth perspective around the question how much autonomy we can give AI agents. Yes, let's have a quick picture. Oh, you're going to be the next speaker, right? Yeah, this works. Thank you once again, and I request Phil to please stay back on the stage as he is the speaker for our next session as well, which is a vision talk on capital formation in the age of agentic finance, when agents price, route, and manage risk. Now, I will skip the long introduction for Phil because he's already been on the stage, but I really want to thank him for being one of our biggest supporters for this event. So thank you, Phil, and over to you.
Hello. Thank you very much. I'm going to start with a quick video. Hopefully it'll play.
I want to buy swaps on mortgage bonds, credit default swap that will pay off if the underlying bond fails.
You want to bet against the housing market?
Yes.
Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
Can we make it 100 million?
So that was 2006. Nothing about how that gets done has fundamentally changed. Michael Burry walked into Goldman Sachs to write a custom credit default swap on a specific basket of mortgage-backed securities. Bespoke risk, negotiated bilaterally, settled off-chain, traded through humans, on paper, over weeks and months. Now imagine the same conversation, but the buyer is an agent and the seller is an agent. Hopefully we can go back to the, there we go. Up. Can we go to slide 2? Anyway, while that's loading, my name is Phil Fogel, and I'm one of the founders of Cork Protocol. I want to spend the next few minutes on a specific question. How does risk get priced and risk capital allocated and deployed in a world where the participants are machines? The topic is structural. It's about what changes and what gets unlocked when the buyer and seller of risk is no longer a human at a desk, but an agent with a wallet. There we go. Now we're back. So no one is here today because the agent economy is coming. Everyone is here because it's already arrived. 250,000 daily active agents transacting on-chain right now, which is a 400% year-over-year growth. In financial services alone, non-human identities outnumber humans by 96 to 1. Service accounts, trading bots, risk engines, increasingly agents. More and more, all trading that is done by machines. 165 million transactions on the X402 protocol, the payment standard that Coinbase and Cloudflare shipped this year for machine-to-machine payments. The user has changed. The risk infrastructure has not yet caught up. The agent infrastructure stack has 4 layers that have been built. And there's one layer that's still missing. Identity, done. ERC 8004 went live on mainnet in January. Wallets, done. Coinbase Agentic shipped in February, along with Turnkey and half a dozen others. Payments, done. Execution, done. DEXs, lending markets, vault frameworks. Risk, nothing. Agents can create risk. Agents can amplify risk. They cannot manage or transfer risk. And that's the gap. And it isn't theoretical. Let me show you exactly what agents amplifying risk because they can't manage it looks like in production today. When the Layer 0 RSETH exploit hit earlier this year, curators like KPK ran exit agents inside their Morpho vaults. The moment the risk signal crossed the threshold, those agents did exactly what they were designed to do: liquidate, exit, pull the capital out. The agents work. They executed in milliseconds. They protected their depositors from the worst case path. And here's the thing. That is the best-in-class agentic risk management today. But notice what wasn't available to those agents. They couldn't hedge the position. They couldn't buy partial coverage. They couldn't negotiate a counter trade with another agent who had a different view. They couldn't structure a swap that would have paid them out below a certain NAV threshold while keeping their upside. Their only tool was out. And when every agent's only tool is out, the second order effect is exactly what you would expect. Liquidity dries up, exits cascade, risk that could have been priced and traded gets resolved by everyone running for the door at the exact same time. That's not risk management. That's a stampede that amplifies volatility and increases systemic risk. We need to give these agents more tools. So here's what almost everyone gets wrong about risk in this space. Everyone hears risks and thinks one of two things: hedging or insurance. Risk on, risk off. Get me out of this thing before things go bad. That's the wrong frame. The right frame, the one that actually matches what agentic finance is going to demand, is risk customization. Take a single Morpho vault token, one asset, 3 different Michael Berries walk in. Same vault, 3 completely different requests. User A says, I want to be protected if NAV drops more than 3%. If it does, allow me to swap my vault token for a stablecoin at 97 cents on the dollar. User B, I don't care about downside protection. I care about liquidity. I want on-demand liquidity at NAV anytime. The third user, I don't want to swap. I want downside insurance that will pay me up to 10 cents per dollar if the NAV drops. 3 different risk shapes, same underlying asset, same trigger, different settlement mechanic, different premium, 3 completely different products. Today, in DeFi, in TradFi, anywhere, those products do not easily exist for the user. You take what's on the menu or you walk away. This is what risk customization starts to look like. Why couldn't we do this before? The answer is mechanical. Human underwriters can't price N versions of the same risk in real time. The economics just don't work out. Geico solved this in the 1990s by replacing human underwriters with an algorithm. But Geico still gives you a fixed menu. You pick your car, you pick your tier, you pick your deductible, and from there, choices. Agents let you replace the menu itself. With agents, you can fully customize, price, and trade any risk, creating more sophisticated instruments and strategies. Agents aren't a feature of risk markets. They're the only reason markets at this level of granularity can actually exist. But before I show you what we've built to enable all of this, one more frame. None of this is possible on the rails we have today. Agents can't transact in traditional financial infrastructure. It's built around humans, around paper, around ISDAs and KYC checkboxes and unstructured emails. An agent walks up to that infrastructure and bounces right off. What agents need is the opposite: structured data, deterministic addresses, atomic settlement, composable state. There's exactly one substrate where all 4 of those exist together. And here's the bigger forecast. Most trading volume in crypto is already AI-driven. The same trajectory is coming for traditional finance. When AI runs capital allocation at scale in TradFi, it has to run somewhere AI can actually operate. And the only substrate that is fit for that purpose is a tokenized one. Institutional capital is coming on chain, but they need more than exit-only risk management. So now, here's what we built. Cork is one smart contract structure, one template, configured by Oracle, by collateral, by trigger, but always the same shape underneath. Here's how it works. Take any on-chain asset that has risk, a yield-bearing stablecoin, a vault token, a tokenized treasury, or any RWA. A liquidity provider deposits collateral against that risk. The contract issues 2 tokens, a swap token and a principal token. The LP, or underwriter, holds the CPT, the Cork principal token. That's the underwriting position. The LP then sells the swap token for a premium. If the trigger never fires, the LP's principal matures back, plus the premium they have already received. The buyer holds the CST, the Cork swap token. That's the policy. It grants the right to swap the reference asset or trigger a payout for collateral at a predetermined rate. 2 parties, 2 tokens, 1 contract. Fully collateralized from the start. No margin call, no counterparty default. The same primitive handles a stablecoin depeg, a vault redemption delay, a NAV trigger, or a real-world insurance event. Only the configuration and the Oracle changes. All 3 of the user examples from before can be created seamlessly on Cork. Cork wasn't retrofitted for agents. It was designed for them from the start, with a singleton architecture, deterministic addresses, ERC 7683 rollover intents, off-chain quoting with on-chain settlement. Read the state, simulate the price, mint the CST. That's the whole loop. No middleware, no human-facing UI to scrape. Not retrofitted for agents, designed for them. Now, once you have that initial primitive, 3 things can stack on top. At the base, you have agentic market creation. Agents spin up pools on demand. Each asset gets 6, 12, 200 variants, tuned to different buyer preferences. The marginal cost of creating a new market drops to near 0, which solves the cold start problem that every risk market has faced. In the middle, you have agentic primary underwriting. Once a market exists, agents on the supply side price it. They model exercise probability, premium curves, break-even NAVs, adverse selection, etc. They post limit orders, and capital gets priced into these freshly created markets. At the top, you have agentic trading and underwriting between vaults, tranched CPT portfolios, reinsurance-style secondary risk transfer, structured products built from composable primitives. Pick risk by sector, by duration, by trigger type. The way fixed incomes desks build credit books and securitizations, except now the desk is software. And on the demand side, the agentic buyer, the agent on the other side of every one of these markets, the one that today has only out as a tool. So why does this matter to anyone who isn't already in DeFi? The same primitive serves 3 different markets at 3 different time horizons. Today in DeFi, there's 80 billion, although those numbers are going down a little bit, in TVL. Roughly 120 million of that has any kind of risk coverage. Nexus Mutual is essentially all of it. And here's the thing, that 120 million is almost entirely smart contract risk. The financial risks that actually matter in financial markets, vault nav drops, stablecoin depegs, slashing events, bad debt, have effectively 0 coverage. The category basically doesn't exist yet. Then you have real-world assets which are arriving on chain, something in the order of $30 billion in tokenized RWAs as of the last month, 4 times the value of a year ago. As more credit moves on chain, you need 2 things in parallel: liquidity infrastructure for redemptions and credit default swap-like pricing on chain for the credit risk itself. Neither exist at scale yet. Last, you have traditional insurance. which has $7.2 trillion in global premiums. The industry runs on software that was built in 1988. When these traditional risk contracts come on chain, we will see massive efficiency gains, faster settlements, and a new capital market formation stack that will lead to more competition and ultimately lower premiums. Same primitive, 3 markets, only the configuration has changed. Here's the universal truth that this room already agrees on. Blockchain is the rail for agentic finance. At least I hope we all agree on that. But every layer on top of that rail has needed its own infrastructure. Identity is being built, wallets shipped, payments shipped, execution is the most mature layer of all. Risk has barely started, and that's what Cork is, the rail for risk. The loop is being built now. In the next 24 months, capital formation in agentic finance either gets built on programmable risk primitives, transparent, composable, fully collateralized, or it gets built on the same opaque, bilateral, off-chain plumbing that gave us 2008. This is the choice that gets made. It's for us to pick. Now, picture the Big Short scene in 2028. No Goldman desk, no ISDA, no suits in a conference room. The user types hold this position for 6 months. I need 100% exit liquidity on 250K of notional. The agent finds 3 underwriters, quotes the price, best quote is 280 basis points, the CST mints to the wallet, which atomically settles on the acceptance. Tokens land in the wallet. That's the future that this room is here to build. Thank you very much, and I'm happy to take questions if there are, or you can feel free to contact me.
Thank you all. I see that as we are nearing towards the close, there are more people outside. Some of you are patient and kind enough to stay in and be super attentive. Obviously, you care about the session and what we're discussing here. So that's amazing. We have 3 very interesting sessions to go. The next one is actually a case study on legal agents in practice, what autonomous IP workflows teach us about trust and liability. And the speaker is already here. He's been listening to the previous sessions. I would like to welcome on stage Moritz Breitenbach with a nice big round of applause. I hope I got your name correct. Thank you. He is managing partner at Zeibig Heigen intellectual property attorneys in Berlin, and he began as a scientist. He's been studying interdisciplinary sciences at ET at Zurich and UC Berkeley. I'm going to skip the long introduction because of the fact that we are super late into the evening and also running a bit behind, but today he advises deep tech and AI founders on patent strategy and leads patent due diligence in fundraising and M&A, and he teaches IP law at the University of Kassel. I would like to hand over to him to take the case study forward. Thank you for being here with us today.
Thanks for the introduction. So I guess I'm the last, well, not yet the last one between you and the beer. So let's, just one quick question. Who of you knows that or thinks that software might be patentable? So who thinks that you can patent your software? That's usually, yeah, that's about the answer I usually get on that question. So hopefully after this, you will have a rough idea whether you might get a patent on whatever, whether it's an agent, whether it's AI as such, or just pure software that you do in order to determine whether and how you might get a patent on it, and in order to determine what might be the value of it. So, because if you don't do it, your competition might go for it. So let's start. I was told I have to point there. No? Not yet. Yeah. All right, wrong button. So, here we go. most and foremost important thing that you should take home with you is the technical effect. And what is the technical effect? It's not some lawyer fog, it's something you can measure and determine. So you take your AI, you take your algorithm, you take everything that goes with it, and try to file a patent for it. Usually, it's not working. Usually, what you get for an algorithm, it's just pure math. That's Article 52, European Patent Convention, excluded from patentability. So no way you will ever get a patent on that. However, what's possible to patent is if you can show that your algorithm, agentic AI, whatsoever, achieves a effect in the real world. What could be a technical effect? A technical effect is anything you can measure in the real world and which is caused by your system. Let's put it that way. So we will go into detail, and there will be some examples about that in a minute on the next slides. Important for you is to ask what's the technical effect and which objective is solved by this technical effect. A patent is always it's a technical right, so you have to solve a technical problem, and the way you define it is up to you. So it works perfect. So here are two examples of software or AI that obtained a patent from the European Patent Office, which is where you would go usually in order to obtain patent protection in Europe. The first one was a neural network in order to determine the heart rate. Objective technical effect that was achieved was determining when there is abnormal behavior of your heart. So it rings an alarm, calls the ambulance, whatsoever. So the problem is a pure technical problem, right? Determining whether there is abnormal behavior with your heart. So on that invention, even though it's a neural network, patent granted. 20 years of exclusivity on that invention. So everyone else is blocked. So talking, you know, once you have a patent, you basically have a state-granted monopoly, right, on your, if you do it the right way, on your business model. So why compete if you could have a patent? Second one, and that goes the training model, that goes really to the core, what you can consider of AI stuff that's usually, well, most of you thought when they come here is not patentable. They trained a model faster on the GPU, so they actually adapted to the technology it's working on. And that's the other, like the second option you have. If you don't have a technical problem that you solve in the real world, you go to the technology, so phrased chip level you're running on. And if you can improve the level your software is running on the chip, you can reduce the resources, or you can reduce the time required for training. That's a technical effect, and that was granted here. The European patent number you see there. So that's another patent granted. On the right side, you see what's not working, usual classification. So that's purely administrative work, right? That was just outsourced to a computer. That's nothing you would obtain a patent for. It's nice to have. There are relevant business cases utilizing this, such an invention. However, for a patent attorney, that's less interesting. And what you can often see is like even the second one on in the red box, which is the inventors here. They thought they comprise the code in order to save memory space. So from an engineering perspective, they thought, well, that's classical engineering, so let's file a patent for it. it was not technical per se, since just saving memory on a chip without any further effect was not considered providing a technical effect, so no patent on that. So that means the patent route is open if you consider it in the right way. And now the question is, how to identify, or what's basically a valuable patent, right? Because in the end, it's an invest, and you want to have a return of invest, right? For that. So what usually happens, and it's if you go to if you look at the previous slide. The guys on the right side, right, with the smaller network, they are engineers. So that what usually happens when you consider a patent, you have an engineering or whatsoever background, and you start from your tech. So you start with the technology and consider that's a groundbreaking idea, that's innovative tech, that's, smart ass in the room, and you want to file a patent for. That might be a good way. You can pursue that way. The way I see it is when you consider your business model and the way your company runs or is supposed to run, you want to first ask what's the customer touch point, or actually the decision. Why customer chooses my product or my service over the guy next to me. So if you know the difference, why they choose you, that's a good starting point. If you use that as a good indication on what you want to protect, because again, talking about patents, we are talking about a monopoly. So if you can monopolize the reason the customer is buying you, I guess it's very much self-explanatory why that follows to a valuable patent, right? So first question. Second question is, how do you generate value for in your company? What's the value generating, most value generating step within your business model? Thinking about the business model canvas, right? So do you know it actually? If not, you should ask yourself, what's the step within my business model that generates the most value for me? If you have identified that, that's the second point you should look at. And finally, the third point is the technical feature. So you have to identify this technical feature with a technical effect in one of those two areas, right? Customer choice and value generation for you. Because if you think of it backwards, if you can get a patent on one of those domains, it's valuable for you. So yeah, I think that's all I wanted to say on this slide. So start from the business model, not from the technology. Second thing you should take home. I really just want to go over this quickly. The way I see an agentic architecture, even though it might differ and you might have a different view on that, is first of all the orchestration. Again, from a patentable point of view, right? So the orchestration and how the agent is orchestrating, sub-agents, etc. So the example here, which is very well technical, as you can see, is the charging of a battery. So if the way the agent orchestrates the charging of a battery in order to extend or at least provide the time life you want to have for your battery, is achieving a technical effect in the real world, and it's controlling a physical system. So that's something that would definitely be worthwhile patenting if it fits into your business model. Second one is the tool use pipeline. So if your agent, again, controls a certain outcome, like production, a proper production of whatsoever, right? You reduce waste, and thereby you also achieve a technical effect, so patentable. And the third line is memory architecture. So in case you can assure that the memory space is saved and is recoverable after whatever disturbance, for instance, same. Physical operation, absolutely patentable. So I think I was short on that one. Things that don't go is GPT wrapper, basically using someone else's model. It's basically like, driving another's car, engine, and, make a fancy dashboard. That's nothing that goes. So if you, again, no technical effect, you've provided, you've solved, leave it out. Second point, the math itself, go back, what was it, I think slide 6 or whatsoever, not working, excluded from patentability. So finally, standard drag. It's nice, it's a good feature, however, usually it doesn't solve any technical problem. So no technical effect, you can leave it. You can basically save your money for other stuff. That's almost, I guess I'm catching up some time. That's almost the last one. Usually when the startups ask all right, what you should consider whenever you are a startup or you're working in a startup as a pre-seed, right? In the lab, as I have a science background, lab journal, we note it down, keep it secret, don't present it, don't tell to investors, keep it where you have it and make sure it works. And shut your mouth about how it actually works, right? Seed, you want to file before you pitch. That's the right sequence. Not pitch and file the application, then you can pitch. Then you have it secured. You have 12 months to improve, to make it running, and to make country selection. So Series A is basically when you start a round and you try to build a portfolio. Why? Because in the end you can tell the boring story. You have filed your application, you got a patent granted, you have made sure that you're allowed to do what you want to do, and in a perfect scenario you can show that the features you've protected are, the ones everyone wants to have. So with that, I can end, and yeah, I think everything is on the slide. So if you have any questions, feel free. If not, shoot me a question afterwards. Thanks for having me.